HSBC CEO Flint exits abruptly after only 18 months in role. Flint's exit, which a person familiar with the matter said was a result of differences over execution of his strategy, was disclosed early on Monday along with HSBC's half-yearly results, which had been scheduled for release later in the day. The departure comes as Europe's biggest bank is grappling with headwinds including an escalation of a trade war between China and the United States, an easing monetary policy cycle, unrest in the key Hong Kong market and uncertainty about Brexit. Flint ran HSBC's retail and wealth management business before taking over as CEO in February 2018. His appointment was the London-headquartered HSBC, which makes more than 80% of its profit in Asia, said Noel Quinn, the head of its global commercial banking unit, will be interim chief executive. While the bank did not elaborate upon the reason for Flint's sudden departure, a person familiar with the matter said it was a result of differences of opinion between Flint and Tucker over the pace and result of the strategy execution. The main difference arose from Flint's softer approach to cutting expenses and setting revenue targets for senior managers to boost profit growth, said the person, declining to be named due to sensitivity of the issue. An HSBC spokesman in Hong Kong declined to comment. When he was picked as CEO, Flint was viewed by HSBC executives as a safe option as he had been with the bank since 1989 and worked across most of its businesses. He spent the first outlining his strategy at the helm of the bank in June last year. Flint set out plans to invest $17 billion in the next 3 years in areas including technology and China. Revenue risk. HSBC's pre-tax profit for the first 6 months of 2019 rose to $12.41 billion from $10.71 billion in the same period a year earlier, helped by a surge in retail banking and Asia revenues. The bank flagged the risk to its business from the US-China trade war and the change in the interest rate cycle. The tit-for-tat tariff war between the world's two largest economies has taken its toll on trade-focused banks like HSBC and rival Standard Chartered, which last week warned of an impact on its business customers from the escalating tensions. The bank was managing. Prior to the latest buyback announcement, HSBC had purchased more than $6 billion of its own shares since 2016. Analysts had been reporting by Sumit Chatterjee in Hong Kong and Aditya Soni in Bengaluru. Editing by Nick Z.
Raindrop, truck top, smoking, no cooking the hot pot. Fucking on your bitch, yeah, that. Looking up, open the park.